to be long gold through this run up. $4,000 an ounce is supposed to be time they just taking off some of that risk, particularly as we get towards the end of the year. You got a lot of profits. Fed's going to cut rates in October and December, and that's been a consensus with Ira Jersey, and what's on the the expectations that they're going to cut 25 the next two meetings.
And Mike, you've been right about this, that gold has taken off, and I'm not surprised. I'm not surprised that gold took off first. I wrote about this a few weeks ago, that gold is the leading indicator for risk around the world. When you have a risk-off trade, people are going to either gold or treasuries, but they're going to gold.
Gold prices have surged to new highs this year, becoming one of the strongest performing assets in a volatile global economy. As central banks around the world accumulate gold at a record pace, the precious metal has reasserted its role as a hedge against risk and monetary uncertainty. But analysts are now warning that gold's rapid climb could also signal a broader shift in market sentiment, one that often precedes a correction across risk assets. With inflation still stubborn and rate cuts expected later this year, investors are facing a critical moment: take profits or ride the wave into potential turbulence. Bloomberg's senior commodity strategist MikeMcGlone and macro investor James Lavish break down the evolving risk landscape. McGlone explains why gold has become the global risk barometer, leading other assets, such as Bitcoin and equities. Lavish adds that while central bank demand remains a strong fundamental driver, gold's overextension suggests it may be time for investors to manage exposure and lock in gains. Both warn that complacency in equity markets mirrors late-cycle optimism seen before major downturns. As they highlight, even traditional safe havens like bonds aren't offering clear safety, and the next Fed moves could determine whether this rally sustains or reverses sharply. The takeaway? Gold remains the ultimate risk hedge, but even hedges can overheat. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Our chief interest rate strategist, Ira Jersey, he said, yeah, market's all set up for another 50 basis points cuts this year at the next two meetings. Terminal rate has shifted to 3% a year from that. We pointed to that a little while ago. 10s and 30-year auctions this week. He's still looking for that bullish steepener. Thinks it's just a matter of time that 2-year yields drop to that 3%. Right now they're 3.59. Michael Casper, our equity strategist, pointed out S&P 5 earnings remain strong, but unemployment trending in the wrong direction is not a good thing. Small caps remain much better value than large caps. Kind of their market pulse index on the large caps is approaching manic. Audrey Childe-Freeman, our FX strategy, pointed out the weaker yen, with Takashi getting elected first female in Japan. I find that somewhat shocking, after having worked for the Japanese for many years ago. And sure, but she's certainly associated with expansionary monetary policy. So seeing that little weak yen today, so not much different from her. And me, my point was, I put on my risk management hat. I pointed out I got my FRM in 2006, which has been a long time ago. I've never really used it, but as a risk manager, I just pointed out gold is just so expensive here. If you've been lucky enough to be long gold through this run up, $4,000 an ounce is supposed to be time they just taking off some of that risk, particularly as we get towards the end of the year. You got a lot of profits. And I pointed out the key thing I know Dave pushes back on a lot, and I've seen this a lot, is I want to point out, if you just take what have you done for me lately versus gold, you take Bitcoin versus gold. What have you done for me lately, Bitcoin? You have to go back to 2021. It's a flat line. I pointed out during that period, Bitcoin is traded about 3 times the volatility, yet same performance. And then I also pointed versus the S&P 500 total return versus gold since 1997. It's a flat line, yet S&P 500 typically trades a higher volatility. You don't see that from all those people pushing stocks. And this one pointed out, part of that's how expensive gold's getting. Part of that means there's the paradigm shift kicking in. And the things I see also from stock market volatility getting hammered, crude oil just staying below that last year's low, that I remain very, very concerned as we head towards the end of the year. We might just get a pickup in volatility. I mentioned the one key thing that can bring our wonderful government to end the shutdown is the stock market going down and telling them to, like they did with TARP. So you have to be very careful in those environments, and that's when the risk manager, which I've always been kind of astute at, comes out and says, hey, let's manage some of that risk. Let's switch to derivatives, lock in some of those profits. Don't be stupid when we get normalization. It's not a when, it's an if. Maybe it doesn't happen this year, but that's where we're getting to these stages now. I just sense the kind of bullishness I remember in 2017 and some of the peaks in 2021, 22, and certainly in 1990 in the stock market. And there's always a reason. So let's forget about the reason, point out where we are, what it means. We have this government shutdown going down, and I have to tip over to, I think it's going to really matter. I don't think it's going to stop. Certainly, if you listen to that interview with Caitlin Long, now this is my take after 61 days, that we have a very emboldened president, and he says it's a good thing. And I don't think anything's to stop unless beta goes down, goes and forces them to the negotiation table. And this is where we're out now, and that's what gold's predicting. And record highs in a very high volatile asset like Bitcoin's great, but just imagine a year if the S&P 500 wasn't up 15%, and we're going to get that when it's down 15%, or even maybe this year. And that's why I just say this has been a great year for those invested overweight long gold. And you had half the volatility. So it's just all the other stuff to me is noise, and you got to be careful of the noise.
Mike, you have a chart there. Do you want me to bring something up?
No, I don't want to annoy you with more charts. I'll show you one, because this is something I've had an inkling for a decade. Partly because I used to be on the sell side of this product. Glitter is just a basket of precious metals. You take the Bloomberg Galaxy Crypto Index, which I was instrumental in launching at Bloomberg. You have to go back to 2017 for a flat line of this basket of all these great crypto assets that everybody's trading on their phones for nothing, which is great and a lot of fun. And divide that by just a simple basket of precious metals: gold, silver, platinum, palladium. People are starting to realize the value of just 4 precious metals versus 21 million cryptos that you can trade. It's great, trade them. But at some point, that's going to be a problem. And this is why I point as a problem. When you just have to have this has to keep going up. Stock market has to keep going up. That's not a trade you want to be in anymore, I don't think. When it was cheap, sure. But now here, you want to look for alternatives. Even gold's getting expensive here. And that's why I think the only thing I have left, if this goes down, is T-bonds. And that's the number one thing I've been wrong on for 2 years.
But why are yields still going up even as the Fed cuts? Given I understand the mechanics, I'm just saying it's hard to get excited about bonds when
that's the key thing. That's why
can't manipulate them up.
That's why on a 1 to 10 scale on the global basis for macro, the 10 is one thing. The U.S. stock market, it has to keep going up. So if we get just a little 5% correction, that 4% yield on the 10-year is going to drop. That support's going to drop to resistance. Bitcoin will drop 20%, easy. Copper will probably drop 20% easy. That's an if statement. But again, it's the whole that we're that elevated. That's my point is you're cutting rates. The consensus is yes, its stock market goes up. And I just remember 2000, that feels to me exactly like 2007. And it took me a while to make that money back. But that peak after the Fed cut was tough. And then it just went down 55%, the S&P 500 to that low in 2009. I feel the same way now. The thing is, things are so much more expensive. We didn't have cryptos back then. It was, so as your risk manager, you've had a great year, lock in. And
even on gold. So you're saying like
even on gold. That's my point is when gold's that expensive, everything's got a problem. And so that's why I just say, I just had to put my risk manager spidey senses on, and I'm waiting to hopefully publish on it tomorrow is just get out.
I mean, the funny thing is, though, the gold's different, though, because gold's being bought by central banks.
Those are things that we pointed
out.
You're
not going to go take profit. We talk about gold. We talk about buying gold, and you can buy gold coins. You can go to different places to buy coins, but a lot of people are buying it in their IRA or their 401k or whatever it is, and or just their investment account that they have over at Fidelity or Schwab, and they buy something like GLD. So how do you see the relationship of GLD versus spot? Because this is a really important thing for people to understand.
So it's one of those things that gold bugs will be all over, particularly people who have to buy it and put it in their underwear drawer or a safe deposit box. It's a very unlikely, unusual event for that to ever break down. GLD holds the actual physical gold or to have an issue. And it's insignificant. If we ever get that bad, I always like to point out a quote from having a conversation about the same thing, getting bullish gold 10 years ago with my son, who was in the U.S. military at the time. He says, if it gets that bad, Dad, I think I'd rather have guns and ammo.
Global markets are exhibiting signs of a more profound structural shift, as traditional models struggle to capture the magnitude of recent asset price movements. Gold's extended rally, which has consistently outperformed model projections, reflects a paradigm change, one driven by monetary debasement, geopolitical tension, and institutional repositioning. Meanwhile, Bitcoin is undergoing its own evolution. Its volatility, once a hallmark of risk speculation, has been steadily declining, signaling that the asset is maturing and becoming increasingly correlated with broader market behavior. This transition mirrors gold's historic path from speculative hedge to monetary benchmark. At the same time, stock market volatility has dropped to 5-year lows, while valuations relative to GDP remain near record highs, a classic late-cycle warning. The convergence between digital assets and traditional commodities is reshaping the macro landscape, revealing a shift from speculative trading to disciplined, risk-managed positioning. In this environment, the prudent move is not to chase momentum, but to recognize that both Bitcoin and gold now serve as barometers of global liquidity and risk appetite. As liquidity flows change direction, both assets could dictate the rhythm of the next market phase. Let's get back to the interview.
Main commodity guy covering gold is Grant Spohr. I saw him in London a couple of weeks ago. His models have been underestimating this rally the whole way. But it's, again, that's what happens when you have paradigm shifts. Models always are supposed to do that. But I wanted to show a few charts. First of all, I want to encourage everyone to listen to Scott's interview with Caitlin Long that I listened to this week. And it nailed it. And I think the key thing I want to mention to you, if I can just share those charts, if Misha can do that, is James, I think, is going to shift is Bitcoin volatility going up on the way up. I think it's shifting more towards Bitcoin volatility going down, like S&P 500 on the way up, and then it's just trading more like the S&P 500. So here's the way I look at it, and I'm putting on my risk manager hat. Take the current price of Bitcoin to gold. Right now, it's like 32 ounces of Bitcoin per 1 ounce. 3 ounces of gold per 1 ounce of Bitcoin. You have to go back 4 years. Now, I know there's pushback, but you have to go back 4 years for the same level. At the same time, the key thing, my risk manager spidey senses says, you got stock market volatility the lowest in 5 years, 60-day. The highest correlation ever to all cryptos in Bitcoin and to the S&P 500. And you got the S&P 500 the highest ever versus stock market cap to GDP. I'm your risk manager. I say, hey, we've made some good money in this space. You have absolutely zero risk going into fourth quarter to lose money there. By the way, you can replace a lot of those positions with options. I'll show you how we used to do that a lot. And I want to show you one other thing. This is just taking gold divided by its 40, 50, and 60-month moving average. If you go back on the 40. So the point is, this is a place prudent managers say thank you very much. It's been great to ride this. The thing we used to say in the market is give a little bit back to the market. Don't tempt the market gods. And this is a place you're supposed to say thank you, market gods. I'll take some off the table. And if you don't, as your risk manager, and we drop 20% in gold before the end of the year, which will mean nothing in the big picture. Sorry, you've been warned. That's coming out of your bonus. I mean, that's just part of a risk manager running. This is the way life is. And Dave's laughs because Jim, we know this how markets work. So I just also want to show you a key thing I think's changed in Bitcoin. This is stuff we talked about 2008. The Bitcoin, this is Bitcoin volatility versus the versus gold. It's down, it's crushed at 2. It's the lowest ever. That's annualized 2.2 times. It's continuing lower. It's a different market than it was when they launched ETFs in 2017. And futures, and then ETFs, first one in 2021, and then the big ones in 2024. Again, it's this key thing I point out is what has the market done for you lately? The Bitcoin to gold ratio, it shows me the mature market, volatility is declining, masses are in it. This is a big difference from the days we talked about years ago when all those people those articles you wrote about, used to ask me about Bitcoin. Now they don't ask anymore. And that's why I point out this is the key things that's really shifted in the market is macro, bigger picture. I just look at, this is annualized, the ounces gold rolling, the stock market rolling over versus ounces of gold. To me, as your risk manager, I say, don't be short volatility here. Good luck. Yes, it could last for a long time. Don't be long the stock market here. And by the way, Bitcoin has been, its performance, just to keep it simple, has sucked versus gold for 4 years now.
You want to, James? Why don't you talk first? Because I know what I would say. I talk too much, so go for it.
Well, look, one of the things you have to take in consideration here is that Bitcoin's only 15 years old. A little bit over that. And I mean, and it's already a tenth the size of the entire market cap of gold. That's just mind-boggling. So why is that? Well, people are looking for pockets to hide in during these prolonged bouts of high inflation, where the inflation's been over 2% for pretty much ever, since the great financial crisis. And so when you have people who are just looking for somewhere to hide, of course they're going to hide in gold, but they're not hiding in treasuries. That's the really interesting thing here. So when you look back 4 years, I mean, we are in an adoption phase in Bitcoin. It's only 15 years old. So it's going to continue to have plenty of people, Mike, who think about it exactly the same way as you are describing it, which is a risk on asset. It's still, it is still I would say the majority of investors think of it that way. I'm very confident that the majority of investors think of it that way. Probably the vast majority, probably 80% of investors think of it that way still. Maybe even more, especially the institutional investors. They just don't understand it yet. Why? Because you see these articles, they just lump it in with everything else, just like you say, where there's thousands of other cryptos that they can be buying. It doesn't have to be Bitcoin, right? And that narrative continues. So the difference is when people start understanding, wait, why is Bitcoin staying here when all the other cryptos start to collapse? Or why is Bitcoin moving with gold behind it on a lag? Why does it follow gold like this so closely? And that when you get that understanding, that's when you're starting to get, and you start getting articles like this out of JP Morgan. Just remember, JP Morgan's CEO describes Bitcoin as a scam, as a Ponzi, as worthless, as I don't think he's used rat poison. He may have quoted Charlie Munger on it, but his bank put out a piece saying that it's part of the debasement trade. That is this is so important for people to understand that the rest of the street follows JP Morgan in a lot of ways. Not all the analysts, not all the bank, but they have to take their comments into consideration. It's a powerful bank. And, now you're starting to have that conversation. And so that's what's not different this time. That's how Bitcoin is evolving. Like, it's taking time. I said this for a long time. It's going to take time. And that's why you're seeing this kind of price activity. As far as, Bitcoin versus the stock market, it's exactly what you said. It's the attitude towards Bitcoin has not changed much yet. And I disagree with you that everybody knows about it. Everybody's heard about it, but they have no idea what it really is. They have no clue. I still talk to people that I've told Bitcoin about 4 years ago. And I used to think it's my problem that, that I am not explaining it properly. But then they come back at me with article after article about how Bitcoin is used for, illicit activity. It's a Ponzi scheme. There's no value to it. And I can point to these articles on CNBC and Bloomberg and wherever else that prove me right. And, they just still have not, they just can't get their head around it being a different technology. And that takes time for people to understand that. So I completely disagree that it's saturated with interest. It's had a lot of hits and on media, but it's got the exact wrong narrative around it still. And so that's what it is. And that'll continue to bump around and give people who understand it opportunity to do the debasement trade before it takes off over the next number of years. And just like Dave, I don't like making short-term price predictions in Bitcoin. I mean, that's psychotic. This thing could be up or down $10,000 during the show, and so that's just not something you ought to be doing. But looking at long-term trends and understanding what's going on in the world, the geopolitical uncertainties, look at France. The political instability there is phenomenal, and it's underrated how that's happening in Europe. Japan, that is a massive deal that Dave described. You have the female version of Trump in Japan now who's saying not only do we not want illegal immigration, she's going to take it a step further and saying we don't want any. Like, we don't want any immigration. So that is a major statement out of a world, like a world of liquidity out there. And like Dave said, the money printer is going to burr out there because they are over 200%, 250% plus debt to GDP. And that's been the carry trade for the world for a very long time. And basically they just signaled that game on, liquidity is coming out of Japan.
We're entering a phase in global markets where risk and reward are dangerously mispriced. The signals are clear, valuations remain stretched, volatility is muted, and investors have grown complacent after years of monetary support. Yet, beneath the surface, capital is quietly rotating toward real, tangible stores of value. Gold's sustained performance and Bitcoin's maturing behavior aren't coincidences. They reflect the global repricing of money itself. As rates decline and liquidity expands, the search for assets that preserve purchasing power becomes increasingly intense. Whether you're positioned in metals, digital assets, or equities, the coming phase will reward patience and risk management, not speculation. Markets move in cycles, and history has shown that complacency is the most expensive emotion an investor can have. The paradigm shift is already underway. Those who adapt early will define the next era of wealth creation. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.